A taxable event refers to a specific occurrence or transaction that triggers a tax liability. In the context of taxation, when a taxable event takes place, it usually leads to the recognition of income, gain, loss, or some other relevant tax consequence. Different types of taxable events are subject to various tax rules and regulations. Here are some common examples. Sale of assets. One of the most common taxable events is the sale of assets such as real estate, stocks, or other investments. The difference between the sale price and the cost basis of the asset results in either a capital gain or a capital loss. Receipt of income. Earning income is a common taxable event. This can include salary and wages, business income, rental income, interest, dividends, and other forms of income. Taxpayers are generally required to report their income and pay taxes on it. Realization of capital gains. Besides the sale of assets, other events that trigger the realization of capital gains include the exchange of property, gifts, or the involuntary conversion of property, such as through condemnation or theft. Retirement account distributions. Taking distributions from retirement accounts, such as 401(k)s or IRAs, is a taxable event. The distribution is typically subject to income tax, and in some cases, early withdrawal penalties may apply. Inheritance. Inheriting property or assets can be a taxable event, although it often depends on the jurisdiction and the value of the inheritance. Some jurisdictions impose an inheritance tax or estate tax. Debt forgiveness. When a lender forgives a portion of a borrower's debt, the forgiven amount is generally considered taxable income to the borrower. Foreign transactions. International transactions, such as the sale of foreign assets or income earned in foreign countries, can trigger taxable events, subject to the tax laws of the relevant jurisdictions. Business transactions. Various business transactions, such as mergers, acquisitions, or the sale of a business, can result in taxable events. The tax implications depend on the nature of the transaction and the applicable tax laws. How taxable events affect taxation. Tax liability. The occurrence of a taxable event often leads to the recognition of taxable income or gain. Taxpayers are then required to report this income on their tax returns and pay any applicable taxes. Basis adjustment. The tax basis of assets is often adjusted as a result of taxable events. For example, the cost basis of an asset may be adjusted upward or downward based on certain events, impacting the amount of gain or loss recognized. Tax credits and deductions. Certain taxable events may make taxpayers eligible for specific tax credits or deductions. For example, homebuyers may be eligible for a tax credit, and business expenses related to certain transactions may be deductible. Timing of recognition. The timing of recognition of income or gain may vary depending on the nature of the taxable event. Some events trigger immediate tax consequences, while others may allow for deferral or special tax treatment. Understanding taxable events and their implications is crucial for taxpayers to comply with tax laws and optimize their tax positions. It requires awareness of the specific rules and regulations governing different types of transactions and income sources. It's advisable for individuals and businesses to seek professional tax advice to navigate the complexities associated with taxable events.